Welcome! In this video, XCN is at a very critical point. What will he do? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand.
The formation of higher lows and higher highs is one of the most fundamental and reliable indicators of an uptrend in technical analysis and is critically important for understanding the market's direction. This is one of the key factors that investors and traders pay the most attention to when interpreting price movements, serving as a primary guide for determining trend sustainability and momentum. Higher lows occur when the price holds above the previous low during each pullback and rebounds, indicating that buyers are active in the market and are treating each dip as a buying opportunity. Each new low signifies buyer dominance and a reduction in selling pressure. This structure shows investors that sharp downward moves are unlikely and that the current trend is likely to continue upward. Higher lows also indicate increasing investor confidence, as well as rising market interest and participation. Higher highs, on the other hand, occur when each new upward attempt reaches a point higher than the previous high. This shows that the market is gaining upward momentum and that buyers are consistently pushing the price higher. Higher highs are important technical indicators that confirm the trend is strengthening and that the probability of continued upward movement is high. For trend continuity, higher lows and higher highs work together. Higher lows indicate growing investor confidence, while higher highs confirm buyer strength and sustained positive momentum in the market. This dual structure is a strong indication that the uptrend is built on solid foundations and that the price can sustain long-term upward movements. When a market or asset chart shows higher lows and higher highs, it can be interpreted from multiple technical perspectives. First, investors and traders use this structure to determine trend direction. If the price consistently forms higher lows and higher highs, it indicates an upward trend with limited pullbacks. This is an important decision point for investors, as the higher low and higher high structure serves as a critical signal for timing buying opportunities and opening positions. This structure provides investors with the ability to assess the market's current momentum and the sustainability of the trend. The higher low and higher high pattern also conveys significant psychological signals to market participants. When investors observe that the price does not fall during each pullback and rebounds at a higher level, their confidence in the market increases and they are more inclined to take long positions. This creates a psychological mechanism that supports upward price movement. Such price behavior indicates that buyers have taken control and selling pressure is temporary. When this structure is observed in the market, investors generally anticipate trend continuation and are inclined to open positions for the long term. From a technical perspective, the higher low and higher high formation tests the validity of the trend. The price finding support at each new low and breaking resistance at each new high confirm that the market has gained strong upward momentum and that the trend will continue. This structure allows investors to implement strategies supported by technical indicators. For example, moving averages, RSI, and MACD used alongside this formation can clarify trend strength, helping investors make more informed decisions. Higher lows and higher highs play a critical role in identifying long-term trends. This structure shows the market's overall direction and investor behavior beyond short-term fluctuations and corrections. Each new low and high increases the likelihood that the price will continue upward and demonstrates that the trend is built on a solid foundation. Therefore, technical analysts and experienced traders consider the higher low and higher high structure a reliable criterion for determining trend direction and strength. Additionally, this formation provides important information for risk management. Higher lows and higher highs indicate limited pullbacks and a reduced risk of price decline. This allows investors to set stop-loss levels more accurately and manage positions more safely. Continuation of the trend in this manner enables investors to make buying decisions with greater confidence and awareness. The formation of higher lows and higher highs also reflects market liquidity and investor participation. Buyers entering at each new low indicate that the market is moving upward in a healthy manner and that liquidity is sufficient. Higher highs confirm buyer strength and continued market momentum. This enhances trend sustainability and creates long-term opportunities for investors. For trend continuity, the higher low and higher high structure increases the reliability of upward price movement. Investors can observe this structure to open positions, evaluate market opportunities, and manage risk. Each new low and high provides a strong signal that the trend will continue and indicates the potential for the price to reach higher levels. In conclusion, the formation of higher lows and higher highs is one of the most reliable indicators of an uptrend in technical analysis. This structure helps investors understand the trend's direction, strength, and sustainability. Each new low confirms buyer strength and market confidence, while each new high confirms buyer momentum and upward price movement. This formation provides investors with short-term opportunities and serves as a critical tool for determining long-term trend direction. As long as the price maintains the structure, the likelihood of continued upward movement is high, and the trend can be sustained reliably. However, we cannot make an analysis decision based solely on this. Let's look at other metrics as well. Keep watching.
The price moving back above the 200 EMA is considered an extremely critical signal in technical analysis, indicating the strength and sustainability of a long-term trend. The 200 EMA, or 200-day exponential moving average, is one of the most reliable indicators used by investors and traders to determine the overall market direction. This average serves as a reference point that summarizes long-term price movements and helps understand the general trend of the market. When the price remains below the 200 EMA for an extended period, it indicates that the market is under pressure, selling dominates, and upward momentum is limited. However, when the price moves back above this level, it shows that control has shifted to buyers and that a long-term uptrend is ready to resume. This is a very strong positive signal for investors, as it confirms that buyers are actively re-entering the market and that the potential for upward price movement is high. Staying above and moving above the 200 EMA represents much more than a short-term recovery in technical analysis. It shows increasing market confidence, a tendency among investors to take long-term positions, and that upward momentum is sustainable. With the price above the EMA, traders begin to see this level as strong support and consider pullbacks as buying opportunities. Thus, the upward price movement is no longer just a temporary fluctuation, but is considered the start of a solid trend. At this point, investors maintain positions, make new purchases, and the upward pressure in the market strengthens. Price action above the 200 EMA also serves as a filter that tests the validity of the trend. Closing above this level demonstrates the energy required for the market to sustain upward movement. If the price moves above the EMA and remains there, it increases the reliability of the trend for long-term investors, allowing short-term fluctuations to be ignored. In this way, maintaining the price above the EMA provides a critical reference point for long-term strategies and planning, creating strong assurance that upward movement will continue and a positive psychological effect for investors. From a technical standpoint, price action above the 200 EMA also changes the relationship with short and medium-term support points. Prices remaining above this level can transform previous resistance points into support. This transformation confirms buyer strength and a reduction in selling pressure. Investors and traders closely monitor such movements to evaluate upward potential and momentum. The price's persistence above the EMA is considered one of the most important indicators of trend sustainability and long-term bullish potential. Additionally, moving above the 200 EMA is a critical signal for position-taking strategies. At this level, investors generally anticipate that the EMA will function as support, creating buying opportunities during pullbacks. Remaining above the EMA indicates that the trend will continue without being affected by short-term fluctuations, and that the upward movement can be sustained strongly. Therefore, in technical analysis, price action above the 200 EMA is considered a reliable indicator of a long-term uptrend. The price moving above the 200 EMA is also highly significant from a market psychology perspective. This movement indicates increasing investor confidence, rising market interest, and active buyer participation. Investors contribute to the upward price movement by taking positions at this point. Sustained closes above the EMA reinforce the trend strength and create a positive perception among investors, increasing the likelihood of the price reaching higher levels. Price action above the 200 EMA is a strong indicator of trend continuity, especially in large and liquid markets. Prices above this level can continue long-term upward movement without being affected by short-term fluctuations. Investors can track this movement to adjust strategies, manage risk, and evaluate opportunities. Price action above the EMA increases the reliability of the trend for long-term investors, allowing short-term fluctuations to be ignored. In this way, maintaining the price above the EMA provides a critical reference point for long-term strategies and planning, creating strong assurance that upward movement will continue and a positive psychological effect for investors. In conclusion, the price moving back above the 200 EMA is an extremely critical indicator for the resumption of a long-term uptrend, the increase of buyer strength in the market, and the continuation of upward price movement. This situation provides a strong buying signal for investors, shows that positive momentum in the market will continue, and indicates that the price can continue to rise over the long term. The 200 EMA is one of the most reliable reference points in technical analysis for determining trend direction and strength, and maintaining the price above this level reinforces the reliability of the long-term uptrend. Price movements over Fibonacci levels drawn from a bottom to a top play a critical role in technical analysis for predicting potential reversal points and price direction. Fibonacci levels are a tool that reflects natural mathematical ratios and the influence of human psychology on price behavior, and are widely used by investors to anticipate pullbacks and trend reversals. In Fibonacci analysis drawn from bottom to top, the 0.786 level is considered a particularly critical area to watch as a potential resistance point. This level represents the point where the market has retraced 78.6% of the previous move and is viewed by investors as a potential area where the price may change direction, either before reaching the top or as it approaches it. When the price approaches the 0.786 level, it indicates the possibility of a short-term pause or pullback in strong upward momentum. This area serves as a key decision point for determining whether the trend will continue. If the price reaches this level and reacts, meaning it reverses, this represents a critical buying or selling opportunity for investors and directly affects market psychology. Technically, the 0.786 level acts as a balance point where buyers and sellers make concentrated decisions, and price movements here can be very decisive in determining trend strength and direction. Investors closely monitor the price approaching this level because a reversal from here can signal a short-term pullback or a consolidation phase. Conversely, if the price manages to break through this critical area, the probability of the upward trend continuing and momentum strengthening is very high. Often, however, the 0.786 level naturally acts as the point where the price reacts and investors begin taking profits. Therefore, careful observation and accurate interpretation of price movements at this level are essential. From a technical perspective, the significance of the Fibonacci 0.786 level stems not only from its mathematical ratio, but also from its direct relationship to market participant psychology. Investors and traders consider this level a potential reversal point, adjusting their positions and risk management strategies based on how the price behaves upon reaching it. If the price does not bounce from this level, there is a risk of trend disruption and the initiation of a short-term pullback or downward wave. However, if the price begins to rebound upward from this level, it indicates that buyers have regained control and that the trend has regained strength. A rebound in upward movement from the 0.786 level is also seen as an important confirmation that the trend is continuing healthily. A bounce from this point reinforces investor and trader confidence, increasing buying pressure in the market. Such a movement creates opportunities for short-term investors while also confirming trend sustainability for long-term participants. Price action above the 0.786 level demonstrates to market participants that the trend is strong and that upward momentum may continue. A reversal from the 0.786 level also reflects the interaction of resistance and support levels. A bounce or pullback at this level directly influences the positions and psychology of market participants. Traders taking positions here adjust their risk management strategies, may take profits, or protect their positions. Therefore, the 0.786 level is not only a mathematical ratio in technical analysis, but also a critical point where market psychology and investor behavior are closely observed. The potential for a bounce from this level increases confidence in the overall market trend. If the price reacts upward from the 0.786 level, it provides a strong signal that the trend will continue. This reaction indicates that buyers are active in the market, selling pressure has diminished, and the price is ready to move upward. Thus, a bounce from this level supports the sustainability of the long-term uptrend and provides a safe buying signal for investors. Furthermore, price reactions from the 0.786 level make market movements more pronounced. Responses from this level strengthen upward momentum and help traders formulate short and medium-term strategies. A bounce from this critical point also indicates that market participants are correctly interpreting the strength and direction of the trend. In conclusion, when a Fibonacci is drawn from bottom to top, the 0.786 level is extremely important in technical analysis. This level provides a critical reference as a potential reversal point, directly affects market psychology and investor behavior, and indicates trend continuity and momentum strength. A bounce from this level is interpreted as a strong signal that upward movement will continue and serves as a key guide for strategic decision-making. Therefore, the 0.786 Fibonacci level is an indispensable reference point in technical analysis, critical to observing and determining price direction.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.